Greetings from 3Edge Asset Management, and welcome to this monthly edition of View from the Edge for January 2021. I'm Fritz, the Chief Investment Strategist here at 3Edge.
And I'm Eric Biegeleisen, Director of Investment Research here at 3Edge.
As we do at the beginning of each month, Eric and I will discuss our firm's outlook for the global capital markets, which is based upon our proprietary research model. And importantly, we'll point out any significant changes to our model research that may have occurred over the past month. We have a lot to cover, so let's get started. So now we have closed the books on 2020, a year in which, despite the human suffering and economic fallout from the coronavirus global pandemic, saw equity markets actually turn in a very strong 12-month of investment performance, even after absorbing a dramatic downturn in February and March of last year. And now in the early days of 2021, equity markets have continued to move higher, reaching historically high levels of valuation, which is certainly a potential cause for concern. Leaving aside the unfortunate events in the nation's capital, the first full week of the year, markets did get another surprise when the Democrats captured both of the U.S. Senate seats in the Georgia runoff election, which effectively gives Democrats control of the House, the Senate, and the White House for the next 2 years. And the initial response from investors was actually positive, based on the belief that this means that there could be more increases and additional fiscal stimulus in the near future. However, investors are also faced with an alarming surge in the number of coronavirus cases, as well as a potential mutation of the virus, which seemed to make it more contagious. In addition, the initial rollout of vaccinations in the US, Europe, and the UK have faced challenges, and the coronavirus, the global pandemic, is therefore continuing to push the hope for return to normalcy and the hope for full economic recovery further and further into the future. Balancing that out, however, is the Federal Reserve, which continues to pump over $100 billion a month into the financial system, and Fed Chair Jay Powell, as we know, remains explicit about the willingness of the Fed to do whatever it takes to support the economy and the financial markets until a full economic recovery is well underway. So that's a lot, and I'm glad that Eric Biegeleisen, Director of Research here at 3Edge, is here with us today to sort this out. So Eric, why don't we take a look at the 8 major asset classes? I did say at the top of the show here that we like to point out changes that may have occurred in the model, but it seems like from month to month, from December to January, the model's actually been fairly stable. So we'll see if that's changed. Anyway, why don't we begin? We'll look at equities, starting with the U.S. How's that?
Yeah, I think that's exactly right. The model has been incredibly stable over the last month plus, which is very interesting to watch it on a day-to-day basis and see that stability. As it pertains to U.S. equities, we've been speaking about this for some time now, that they're incredibly overvalued by our measure, more so than they were at the height of the tech stock bubble in 2000. And more overvalued than they were prior to the stock market crash in 1929. So is that us saying, oh, there must be an imminent crash coming? But I think the answer is no. Overvalued markets can get even more overvalued. In 2000, for example, by our measure, again, with valuation of U.S. equities, they stayed overvalued for 2 years before correcting. And here we are, we're not even quite a year into the sort of extreme levels of overvaluation that we're seeing now. All that said, the continued accommodative stimulus that you just referenced from the Fed throughout 2020 and that they're currently providing is continuing to provide support for U.S. equities. The blue wave locked in by voters that we just saw, we should expect potentially to see additional sizable stimulus. Hopefully all this doesn't go into Tesla and Bitcoin. And despite the shocking political scenes, markets are continuing to exhibit positive investor psychology. So on a whole, it's a favorable outlook for U.S. equities that would only be more positive if markets weren't just so overvalued.
Right. Excellent. So why don't we go outside the U.S. and look at Japanese equities, which are the most highly ranked of the equity asset classes that we research. What's our research showing us there? Because I believe at this point, Japanese equities are back to maybe levels they were at in early 2000s.
Yeah. Japanese equities have had a great run. They do continue to be at the top of the list in terms of our risk adjusted projected returns for equity asset classes. You know, Japanese equities are benefiting from U.S. stimulus as well as the Fed keeping a lid on rising corporate borrowing costs, which is having an effect on keeping spreads narrow. Additional Bank of Japan stimulus, the central bank in Japan, including their yield curve control mandate, that's helping to position the economy for growth. You know, all of the equities we model, Japanese equities have the most favorable valuation. And we'll
Mm.
probably touch on the valuation of the other equities as well. So that's another positive in the camp of Japanese equities. And finally, as we've noted for some time, Japan has just generally fared better in terms of their response to coronavirus cases, and so that should aid their economy on the other side as well as we come on the other side of the pandemic.
Excellent. So we'll stay ex-US and look at emerging markets now. Also had a very strong year in 2020. What are we seeing there?
Yeah, like the U.S., emerging market equity valuations have become incredibly stretched as well, again, by our measure. But also like the U.S. And Japan, for that matter, EM equities still remain attractive due to the continued monetary stimulus and better growth prospects. Again, when looking at those yield curve measures that we track across the region. Um, U.S. dollar weakness could continue to act as a form of financial easing for the global economy and could benefit emerging market equities.
Japan equities are not dogs, though. We like them.
Yeah.
That wasn't symbolic.
Apologies for the dog.
Uh, See it all the time. Anyway, keeping moving along, looking at Germany or Europe, German slash Europe equities. So finally, the new year ushers in the long-awaited Brexit agreement between the UK and the EU. What is our model research indicating in terms of our outlook for Germany slash Europe?
Yeah, so the U.S. and emerging market equities are joined by European equities as just being highly overvalued by our measure. So that does present some caution in these regions. And similarly, European equities could benefit from better growth prospects as we do see their yield curve measures steepening as well. And so we've been seeing these things, we've been saying these things. So that is therefore a positive despite the level of overvaluation. And additional ECB stimulus, particularly to combat a strengthening euro, that could also further bolster the region for sure.
So positive all the way around on equities, but a little bit vigilant based on the valuations.
I think that's right. That's great.
Maybe not a little bit, but vigilant on the valuation side. Great. So let's switch now from equities, from stocks to bonds. Look at both interest rates and corporate credit. The yield on the 10-year U.S. Treasury now flirting with that 1% level, while at the same time, as you mentioned, credit spreads remain exceedingly tight for now. So what is our model research currently for fixed income markets in 2021?
Yeah, it seems like the blue wave has squarely moved U.S. Treasury yields above 1%. Something we haven't seen since March, when yields were actually heading the opposite direction following the outbreak of the virus. Even at 1%, though, they continue to yield less than the market's expected inflation rate. That is, they provide negative real yield across all maturities. So presently, we find pure Treasuries is just having this, very unattractive risk return trade off. And with regard to credit, we've continued to see support from the Fed for the credit markets or corporate bonds, and that's certainly helping keep our equity projections positive. That helps reduce borrowing and refinancing costs for firms, which is great. But risks do remain to the sheer record amount of corporate debt that's outstanding, and so we're tending to stay away from credit, despite the fact that it's performed well and it's actually a boon for the equity markets.
Yeah, it's kind of interesting because in some respects, the corporate credit spreads being as narrow they are is fairly artificial, right? It's really the faith that the market or the bond market has in the Fed's willingness to step up, and I guess that holds for now. At some point in the future, though, maybe not.
That's right. That's right.
Good, good, good. So real assets, gold and commodities. Gold, very strong year in 2020. Why don't we start with gold?
Yeah, gold performed quite well, though it experienced a bit of a setback in the August to November timeframe. But December was again a very good month for gold, so it may be choppy from time to time. But as expected, inflation continues to rise, and while real interest rates are negative and continue to become more negative, our model and our research is going to continue to find gold attractive.
Excellent.
Yeah.
In commodities, what do we see there?
Yeah, so ever since the sell-off back in March and April of 2020, due to the pandemic, commodities have performed quite well since. And despite these gains, we still find them to be relatively undervalued. So they're still a reasonably attractive asset class just from that valuation perspective. If we see continued U.S. dollar weakness, and the potential for an increase in demand of commodities, should this economic recovery really take place this year, that would just further bode well for commodities.
Excellent. So last is short-term fixed income or cash equivalents. Seems as though our model research is continuing to find interesting enough investment opportunities beyond holding cash, at least for now.
Yeah, I mean that's right. We always refer to our cash as our dry powder and ready to take advantage of opportunities when they present themselves. And we've been invested in Japanese and emerging market equities and gold and commodities, and we find these as great places to use that dry powder now.
Excellent. All right, great. So thank you for getting us caught up on our model research outlook. And now, as we do each month, my favorite part of our View from the Edge videos, I will ask Eric for his 3 most important takeaways from today. So Eric, what do you have for us this month?
All right. Number 1, markets are frothy. By our measure, U.S., emerging market, and European equities are all highly overvalued, while Japanese equities are more fairly valued. So beware. 2, gold and commodities should continue to benefit from a weakening U.S. dollar and a continued decline in real interest rates. And 3, not all is rosy. Risks remain to our outlook. And some of these risks include the following items: significant tax policy change, COVID herd immunity being elusive, sharp increases in inflation unexpectedly,
Yeah.
the bursting of a corporate debt bubble. That is the inability to borrow or to roll over or refinance debts. And geopolitical conflict escalation. There's no shortage of regions in the globe that could potentially escalate in a concerning way, and there are more. So there are a number of things that we're keeping our eye on.
Very good. Excellent. Thank you for that. So that'll do it for us. Eric and I will be back once again in early February with our next edition of View from the Edge. Meanwhile, Steve Cucchiaro and I will be back next week with our first 3 Edge Week in Review for 2021. As a reminder, all of our videos are available on our YouTube channel, and you can feel free to subscribe to our channel. And by doing so, you'll receive notification as we release new videos in the future. So on behalf of Eric and me and everyone at 3 Edge Asset Management, we urge you to remain safe, to stay strong, and to keep the faith. And thanks for listening. Eric, thanks.
Thank you.